Following a CBS News investigation, California's insurance commissioner says he will push to require more transparency when it comes to the state's FAIR Plan for fire insurance. So the California FAIR Plan is one of the state's largest fire insurers, and it's been put in the spotlight following January's wildfires. A recent CBS review of California public records and data found the plan does not publicly disclose its basic financial data and that its board meetings, minutes, and reports are all kept confidential. Now, for context, there are FAIR plans in about 30 states, but California's is the only one that keeps this level of secrecy. Last month, the FAIR plan ran out of funds and received approval from California's insurance commissioner to charge member insurance companies $1 billion to help cover costs. Now, those charges are then passed down to homeowners and insurance holders. My colleagues behind this investigation join us now. Julie Watts is a CBS News California investigative correspondent, and Scott Pham is a CBS News senior investigative data reporter. Thank you both for joining us. Julie, I want to start with you. The California State Fair program, it's often misidentified as state-run. So how is it actually run and regulated?
It's a really good question. So it was created by state law back in the 60s following the Watts riots when insurers thought it was too risky to cover homes in inner cities, right? It was created by state law. However, it is actually an association of private insurers. So every insurance company that is licensed to carry insurance in the state and to offer insurance policies in the state must be a part of this FAIR plan. And they create this insurance of last resort. It is bare bones insurance. It is very high cost because of the level of risk. During good years, they can pay themselves dividend from their reserves. And when there's a big event like the LA fires, well, they don't have enough money in those reserves to cover all of those claims. Then all of those member insurance companies pay into that pot, pay into that reserve. What's interesting here, though, is because taxpayers are not paying for this, it is not a state agency. And that's why we're seeing some of these issues in terms of transparency.
Okay, the taxpayer piece of that's really important information. Scott, I want to bring you in on this. How did the FAIR Plan become one of California's top insurers? I mean, it was supposed to be a last resort, right?
Sure, yeah, it actually happened fairly recently. You know, this plan's been around since the 60s, but starting around 2017, 2018, there was a series of historically bad wildfires in Northern California. I don't know if you remember, but you might remember the town of Paradise, California. It was basically leveled by the Camp Fire. At that time, it was I believe it was the most expensive wildfire in the country's history. Since then, it kind of gave the insurance industry a little bit of a climate wake-up call, where they began to realize that the homes that they were insuring had a lot more risk than they had planned for. So, of course, they went to go raise rates. But California is a pretty famously high regulation state when it comes to insurance. And you can't just raise rates. You have to ask. So they asked the Department of Insurance, and the Department of Insurance, for the most part, said no. In historical times, that has helped a lot to keep the prices pretty reasonable in California, despite the expensive cost of living. But this time it may have caused the insurers to pull back a little bit. A lot of them have stopped issuing new business altogether in the state. Some of them started non-renewing, essentially canceling plans for customers they had, sometimes for many years. And that left a lot of people in insurance deserts where they couldn't get anything but the FAIR Plan.
Yeah, I mean, really quick, I mean, Californians that aren't covered by a FAIR Plan policy themselves are paying for this $1 billion shortfall. How?
Right. So the way this is supposed to work is that if the FAIR Plan goes insolvent, there's what's called an assessment, essentially a fine that they go and fine their parent companies, right? The people that are in this association that Julie talked about. Now, Ricardo Lara, the current commissioner of California, he passed a new rule last year before the fires that changed how this works. Before that rule, 100% of it would have been paid for by the companies. It would have been a private transaction and nobody else needs to really be involved. Since that rule that got changed, the insurers are now allowed to pass on 50%.
Pass it on. Okay,
that's right.
Got
pass
it.
So
it's a legal type of thing that now that they're allowed to pass it on. Julie, before I let you go, the commissioner says he supports requiring more transparency. I mean, it's not solely up to him. So how would this be enforced?
Yeah, well, so because this was created by state law would have to be amended to require more transparency. The law, as it stands, says that their documents and reports are not public record. So what he's going to do, or at least what he tells us he's going to do, is sponsor legislation that would then be written by a lawmaker. It would be introduced and presumably passed. That law would then restructure the FAIR Plan. It would require more transparency, depending on how that law, of course, is written.
Well, great reporting, both of you. Julie Watt, Scott Pham, thank you for joining today.